Using indexing, I earned 7.23% average return during the Great Recession. In this episode, I'm going to address the question how to get 7% return on investment. And it's going to blow you away. It's probably not where you think, but I have been doing this for more than 46 years, earning predictable rates of return of 7 to 10%. You're going to understand and see how you can do this also. So I'm Doug Andrew, and I've been a financial strategist and retirement planning specialist for more than 46 years. And I mentioned I have helped many people accumulate and earn average returns between 7 to 10%. But I like to use the worst case scenario. And so I mentioned the Great Recession. If you don't know when that was, that is typically referred to as the time period from 2001, the turn of the century, after the terrorist attacks of 9/11, to about 2012. It was about 10 to 12 years. It is the worst decade since the Great Depression. It's called the lost decade because so many people who had their hard-earned money in the market during that time period, let's say they accumulated $1 million in their entire lifetime by the year 2000. They were pretty proud of themselves and it was in the market. Now, I'm not going to add any new money to this. Most Americans, that $1 million after 9/11 for 3 years in a row, lost. By the end of 2003, it was down to about 600,000. Now, some people lost 50%. $1 million was only worth 500,000. Some only lost 34%. The average was 40%. Now, what a lot of people didn't understand, including some gurus on NBC on the Today Show, I just thought, oh my heaven, they don't know what they don't know. Because they got on NBC, a panel of 3 of them, I won't mention their names, they're commonly known still to this day, I know them personally. They said, well, the market dropped 40%, but the market is back up 40%, so everything's fine now. And people are going, wait a minute, the market dropped 40, it's back up 40, how come I'm not back to break even? Because they didn't even understand. If the market drops 40%, if $1 million goes down to 600,000, a 40% loss has to be followed by a 67% gain to get back to break even. People go, huh? Okay, if $1 million goes down to 600,000, 600,000 has to regain 400,000. What percent of 600 is 400,000? 67%. It's 2/3 of 600,000. Your 600,000 in 2003 has to experience a 67% increase just to get back the 40% loss. When people lost 50%, when $1 million went down to 500,000, a 50% loss has to be followed by a 100% gain to get back to break even. $500,000 has to double. It has to increase 100% to get back from the 50% loss. If you say, well, I only lost 33%. Well, 33%, $1 million goes down to 667,000. That has to have a 50% increase, half of 667, to make up for a 33% loss. 33% loss has to be followed by 50% gain. 40% loss, 67% gain. A 50% loss has to be followed by a 100% gain. And these gurus are on TV saying, hey, you lost 40, the market is back 40, everybody's happy, right? And everybody's going, well, how come I'm not back to break even yet? It's unbelievable that even gurus don't understand this. It's simple math, you would think. Now, in this worst decade, the era from about 2001 to 2012, we saw people sort of lose their future. They had to put off retirement 7 years, the first 7 years of that, because if you lost 40% to make 67%, it took 4 years, 2003 to 2007, to make back the loss. And so in 2007, people were going, Okay, I finally am back to $1 million. Now, it wasn't worth the $1 million that it was 7 years earlier because inflation had sort of eroded away at it. But they thought, okay, now, honey, I think we can retire. They had to put off retirement 7 years. What happened in 2008? Let me tell you what happened according to Warren Buffett. So, as Warren Buffett put it, in 2008, he said, when the tide went out, it revealed who was swimming naked. And unfortunately, there were a lot of Americans who just had their head in the sand, so to speak, swimming naked, and their money was still in the market, and they lost 40% again in one single year. It took 4 more years until 2012 to make back that loss. And finally, at the end of 2012, I'm going to give them the benefit. It took until 2012 to get back to break even. At the end of 2012, the million was worth $1,046,000. What? Pretty pathetic. 12 years to increase 4.6% or whatever. That's pretty pathetic. This is what I want you to understand. People following our strategies of indexing and rebalancing during that worst decade, if they just used indexing, they would have earned 7.23%. Now, in a 10-year period, if you know rule of 72, you divide 7.2% into the number 72, your money doubles in 10 years. So worst case, the million doubled to 2 million tax-free for our clients that just put their head in the sand. If they were Rip Van Winkle and fell asleep in the year 2000, and they woke up in 2010, and they said, what happened when I was snoozing for 10 years? And you go, you don't know what 9/11 means? Well, isn't that the number you call when you're in an emergency? No, 9/11 is the terrorist attacks. It caused people to lose 40% the 3 years after 9/11, and it took 4 years to make it back. Oh, really? And then 2008, the mortgage meltdown. The what? The mortgage meltdown? Yeah, people lost 40% again in one single year, and it took until 2012 to come back to break even. And you go, oh my heavens. So I'm lucky if I have my money still, my million, and you go check your account in your indexed universal life insurance, and you have 3 million tax-free. And you go, oh, wow. Now, just using indexing, you would have more than doubled your money. By rebalancing, you would have tripled your money. So let me explain briefly what that is, and then I want you to search on this channel for other educational YouTube videos that will help you understand this. But the point is this: in the worst decade since the Great Depression, instead of just losing money and making it back and losing it again and coming back to break even, using indexing, you could have doubled your money. By indexing and rebalancing, you would have tripled your money during that same time period. If you can just simply learn one strategy, indexing, which is simply having your money linked to an index or indices like the S&P 500, the Dow Jones, the Russell 2000. I usually link my return to 4 or 5 indices. I diversify in smart places. Some people say, well, shouldn't you have some of your money diversified over here? You know, you shouldn't have all your eggs in the same basket. And I'm going, so you're recommending I diversify by having some rocks in that basket that's going to break the other eggs? Diversification means having money in a bank earning 1%. That's pathetic. I want to diversify in superior investments. So I link maybe 20% of my money to the S&P. I link 20% to the Dow, 20% for the Russell 2000, 20% to the Barclays U.S. Dynamic Balance Index. These are indices. Maybe I leave 20% of my money sitting there earning 4 or 5%, but not 1%. The insurance company is usually 6 notches higher in safety than most banks. This is where banks put their money, 30 to 40% of their tier 1 assets that we deposit in their institution. They increase the safety and the rate of return by putting it right into the same insurance companies I'm talking about. Bypass the middleman. When you do that, the average of those diversified eggs in the basket have been 11%, netting 10% for the last 27 years. During that worst decade since the Great Depression, fallen asleep, waking up just 10 years later, you would have averaged 7.23%. A million would have doubled to 2 million. But if you every year, you said, wait a minute here. When the market goes up, I make money. When the market goes down, I don't lose, because your money's not in the market. Your money's safely tucked in the insurance company. My million has been in the insurance company the entire time, earning in that decade 5%, a little bit more, but let's just say 5. 5 of the years when the market went down, I didn't make anything, but I didn't lose, because my million is safely tucked in the insurance company, earning 5. If I link to an index like the S&P or the Dow Jones, the only thing I relinquished was the for sure 5%. That's 50,000 on a million. Because I said, you can take that 50,000 and do whatever you need to do with that to have the wherewithal to pay me whatever the S&P does or the Dow Jones. So they buy upside options. If the market goes up, the 50,000 doubles to 100 or triples to 150,000. I capped out at 16%. I made 160,000 2 of those years in that worst decade because I capped out. Now they cap you because they don't have your million to play with in the market. It has to be safe. So when the market goes down, you don't lose your million you started with. You may not make anything because the options expire worthless. Why do I do that? Because in the worst decade with 5 down years, I would have earned nothing. But the 5 up years, I would have only capped out 2 of those years, but I averaged 7.23%. What does rebalancing mean? You ready? So here we go. See, I didn't have 5 years that I earned 0. After 9/11, I go, I don't have to sit here and rubberneck on this economic freeway for 3 years and settle for 0. I just tell the insurance company, oh, just move me back over and pay me the for sure 5%. So that happened in 2002 and 2003 and also in 2008 after the signal at the end of 2007. So I didn't have 5 years of earning 0. I only had 2 years. The other 3 years, because I rebalanced, I earned 5. And as soon as the market started heading back up again, I linked, and my returns went from 7.23 up to 10.07. That's rebalancing. That's why you want to have a licensed professional you meet with annually, and you just say, oh, we just had another terrorist attack, or we just had a pandemic. You know what? Let's just settle for the for sure 4 or 5% this year. Anytime you feel bullish about America, you link your return and you get to participate if it goes up. But if you guess wrong and it goes down, you don't lose. This is the most powerful way to protect your investments and earn easily, based on past history, 7%, but you could actually earn more like 10%. So be sure and watch this episode on how you can tweak your return to 10% by understanding rebalancing a little bit better. But if you want to learn more by reading or watching, let me show you how to get a free copy of my most recent best-selling book. So if you like to read and learn, listen and learn, watch and learn, I'm an author. This is my 11th book. It's called The Laser Fund, and laser means liquid assets safely earning returns. It's my favorite vehicle that accomplishes this. It's indexed universal life, max funded and properly structured. This is 300 pages, charts, graphs, and explanations. You flip the book over and there's 62 actual client stories. The book normally retails for $20. I'll pay for the book. I want you to claim your free copy by going to this website, laser, L-A-S-E-R, laserfund.com. You simply pay $5.95 shipping and handling, and I will pay for the book. Claim your free copy. There's options there to also get audio, video training and education if this is intriguing you. But I want to begin to empower you on how you can get at least 7% tax-free rates of return and hopefully more.